crash this time, it's not just the banks, that are in trouble. It's not just the mortgages. It's treasuries that are a problem because the government is also broke. Part of the reason it's broke is because it bailed everybody else out. It took on all this debt, and it took on a lot more debt during COVID. You've got a national debt now that's almost $34 trillion. It's rising by about $1 trillion every 2 to 3 months. It's so you're talking about $4 or $5 trillion of new debt piling on to the existing debt. Meanwhile, over the next 3 years, half the debt matures, right? So talking about a situation like, you got a balloon payment. So all this debt is maturing, but it was borrowed. The money was originally, the loans were taken out, and the government was paying, 25 basis points for that money, for 1 year paper, 2 year paper. Now it's 550 basis points. And when it matures, so the cost is going up by a factor of 10 to the government to have to pay the debt. At the same time, the debt itself is skyrocketing. So interest rates, or the interest expense, by the end of this year, it'll be about $1 trillion a year, almost, but it's more than we pay on defense. It'll probably double by the end of next year to be $2 trillion. And it'll mean that interest on the debt will be a larger expense than Social Security or Medicare. And then it's going to keep rising. And at some point, interest on the debt will consume 100% of tax revenue. In a couple of years, it'll probably be close to 50%, which is already, crazy. I mean, imagine, going into a bank and you want to borrow money to buy a house, and you're already, and your debt payments are already 50% of your income. It's like, and I want to borrow more money. So, I mean, how is the U.S. government going to convince people to lend it more money when it's already devoting half of its tax revenue to paying interest on the money it's already borrowed? And of course, we can't even begin to repay the principal. We have to borrow that, because whenever the bonds mature, we have to find a new lender. We can't pay anybody back because we don't have the money. Now, of course, we could print the money, but that means it doesn't have much value. That means you have runaway inflation. And so that's, I think, where the markets are headed. And that's why I think it's more of a sovereign debt crisis and a currency crisis, because we have two options, both of which are bad. The first one is default, where the government defaults on the treasury debt, defaults on its commitments to, guarantee mortgages, whatever it is, and the lenders actually lose their money. But the alternative to that, which is actually worse, but more likely, is that the Fed does print up enough money so that the government doesn't have to default. But now we all get repaid with money that has very little value. And so in that type of inflationary default, in real terms, purchasing power, people end up losing even more money. And it's not just the creditors that lose money. Like if the government defaulted on a treasury, the owner of that treasury would lose money. But if you didn't own the treasury, if you just had cash, in your mattress, it didn't affect you. But if the government just prints up a bunch of money, or the Fed prints up the money so the treasury doesn't have to default on that mortgage, then if you have cash under the mattress, you've lost. That cash has lost purchasing power because everybody who owns dollars suffers from inflation. Yep. It's like I just got my bill the other day for a house I have in Connecticut, and my homeowner's insurance was up 19% from last year. But last year was like a huge increase. It was almost like a double. And when I asked the realtor, my insurance guy, what's going on here? And the big thing is the replacement costs for the parts, for the material, and then also for the labor. So if something happens to your house, it catches fire, and we have to build it, it's just going to cost a lot more money to do it. And so they got to charge me much higher insurance rates. But also a lot of these insurance companies have lost a lot of money. They also, bought all these overpriced bonds when rates were low, and they paid out a lot of claims recently with natural disasters. So, they don't have the money.
They're canceling policies.
A lot of people, yeah, and in a lot of high risk areas, if you're more prone to you're in flooding or hurricanes or fires, the insurance company's like, we can't take the risk. We can't insure these properties because we're losing money.
What happens to the borrowers that promise to carry the risk insurance for the bank's asset? Really?
Yeah, I don't know, because most mortgages, they require you to have some kind of insurance on the property. But if you can't get the insurance, I don't know what they're going to do. If they'll
accelerate it.
Yeah, but in those areas, though, the prices have to start coming down, because if nobody can get insurance for your house, that's going to impact the value of that house. Because who's going to buy the house if they can't insure it? Only somebody who can afford to self-insure, but you're shrinking your market of potential buyers, and then people will pay a lower price. But a lot of this too, a lot of the houses that exist in high-risk areas, the government subsidized. Like a lot of times with flood insurance, the private sector wouldn't even underwrite it, and so the government said, "Oh, don't worry, we'll give you these cheap flood insurance policies." And okay, I'll build my house right by this river.
They enticed them to build.
Yeah. Whereas the free market would have kept people away, or would have caused them to build in a way that would have mitigated the risk. Now, it would have been a more expensive construction project, but if the government just says, "Oh, don't worry, we'll subsidize your insurance," then that caused very risky behavior. And then it was back in 2008. So today, since the most valuable asset that the homeowner has, really more than his home, is his mortgage, a lot of people are going to want to stay in those homes. Even if the home price goes down, their mortgage is so low that it still might be cheaper. Let's say I've got a house and I paid $500,000 for it, and it's worth $400,000, and so I'm underwater. Back in 2008, the borrower would say, "Well, I'm wasting my money. Why am I going to pay this mortgage? I have negative equity. I'm just giving money to the bank. I'll go rent something, or maybe I'll buy something else at a lower price." But even if you bought something at a lower price, if the mortgage was 8% and not 3%, even if I got a better deal on a home, my monthly payment is going to be higher. And the same thing with rent. A lot of people might be living in a home that they paid $400,000 for, that's worth $300,000 or maybe even $200,000, but their mortgage is so low that if they just walked away and they rented a property, their rent would be higher. So it's like, doesn't matter that I'm giving money to the bank. I got to live somewhere. I'd rather give it to the bank than a landlord. So that's an incentive for people to stay in their homes and continue to make payments, even if they have negative equity. So that's going to keep some of the supply off the market, maybe a lot of the supply.
I have never
that people might rent out their house rather than just selling it. Because if you sell it, you lose the mortgage, right? It goes with the house. And these mortgages are not assumable, so the new buyer can't get it. But the renter can benefit from your mortgage because you keep paying the mortgage and he gives you rent.
So we have
crashes, and then the Fed is able to slash rates and mortgage rates come way down again. That would change the dynamic.
But that also
too, and this is, this happened before. People will decide they're just going to stop making their mortgage payments, and they're not going anywhere but it could take the bank years to get you out of there. And especially if, the government comes in with some kind of forbearance, well, you can't evict anybody, you can't foreclose on anybody because it's an economic emergency, so you create another moral hazard. But the other thing that happens too, when people have negative equity in their homes, they don't make repairs. They just sometimes they don't even pay their property taxes because it just adds on to what. One of the things that I predicted even before 2008 is that people, once they knew that they were going to default on their home, they started, they taking the plumbing. They figured, hey, they take the fixtures out, start selling it, because by the time the bank got the house back, it was an empty shell. And you can't really sue the homeowner for the way he used his property. It's like, what happened to the granite counters?
Yeah.
What happened to the appliances? What happened to the copper plumbing that was in the house? Yeah, so it's a very precarious situation, for the lenders. But again, the thing that's going to happen also this time is very high inflation. So in nominal terms, prices might not drop a lot, but in real terms, right? If you want to compare what does a house cost compared to, a bag of groceries, or a gallon of gas, you're going to see that the real price of real estate has come down dramatically. A better way to price it would be in gold, right? So if you look at, gold's about $2,000 an ounce. So a house that's $200,000 is 1,000 ounces of gold, right? Now you might be that house might go up from 200,000 to 300,000, but it might go from 1,000 ounces of gold to 500 ounces of gold, right? So it doesn't matter that the price has gone up in dollars. It's half off in real money. And that gives you a better measure of what's happening.